Hello and welcome to part 10 of my Startup Funding course. In this lecture we're going to look at what are investors looking for. The first factor that investors will find very important is the strength of the management team. A core team is essential to success and you should have all the major roles covered. Don't underestimate the importance of a co-founder. This mitigates execution risk for investors who do not want to have to replace key management members after they've made their investment. Although it has to be said, VCs often do, so they don't often get it right. Remember, a great team with a good idea is better than a good team with a great idea. Investors will also want to gauge, can the management team grow with the business? Don't forget a track record's also important. Have you done it before? If it is your first time raising money, it's often a good idea to bring on a co-founder who's got experience of raising money for investors and a track record. This will also help to attract investors who've been successful with him in the past. A large market is critical, and this market needs to be not just large but growing, ideally $1 billion plus, making it a competitive opportunity. This is key to the investors getting a strong return, and they will have little interest in small markets, mature markets, or niche markets. And don't forget, the key question they really want to know is, can you disrupt this market? Strong margins, and by this I mean strong gross margins, are also important. This is the key to good cash flow. Ideally, you should be at 60% plus if you want a benchmark. There is, however, a trade-off between strong margins and fast growth. Investors will want to know what their exit strategy is. Bear in mind that VCs seek a 5 to 7 year investment period. They'll want to know how and when and who will buy this business. Don't suggest that it's going to be a secondary deal that will get them out of it, i.e. another VC coming in. You're better off proposing either an IPO or a trade sale. But you need to have some clear idea of who the trade buyers might be. Investors like to see proprietary technology, ideally patent protected. This should be unique, with strong barriers to entry and strong barriers to imitation. Regulatory barriers are also good. You should be able to demonstrate unique processes and methodologies, and some unique unfair advantage which will be the key to your success. Upside value is important. Bear in mind that VCs take a portfolio approach, and they know there's a risk of failure or underperformance, so they need to believe that the investment is going to deliver at least 10 times. Next, we need to turn to the use of funds. You will need to have a clear business plan and a clear financial plan, and I've already alluded to that in this series of lectures. But you also need to be clear as to what the funds that you're asking for will be used for. This clear understanding of business cash flow, when you're going to reach cash break even, the need for further rounds of funding, and the milestones you're going to cross in order to get there are all important. Don't forget, further rounds have implications for dilution. Make sure you have a contingency fund and that you know what your burn rate is and therefore your runway, how many months of funding you're actually going to end up with if you raise the money you're asking for. You need to nail down this data and this data in detail, so don't wing it. Realistic projections should be grown bottom up, firmly based in reality. Beware of presenting hockey stick scenarios. You should make your assumptions clear and justifiable. And are your assumptions consistent with market conditions? Because if not, you need to explain why you're proposing that you're going to beat the market. Traction is important to investors because they want to see traction with customers. This gives them proof of product, proof of customer demand, and a clear understanding of the potential for market demand. Paying customers are not pilot projects, and therefore, it's important that you have proper customers under your belt when you come to investors. Bear in mind too, at some point, they'll probably want to speak to your customers. Scalability is critical. How difficult is it for your business to become a large company? What are the constraints to growth? Is it people? Don't forget, software businesses are always more attractive than services. Vision. Now, we talked about this right at the beginning of these lectures. You must be able to communicate your vision. You must be able to show your passion for the business, because when the going gets tough, they want to know that you're going to keep going. Finally, an eye for detail is important. You must show clear command of this detail. What is your opening cash position in the morning, and what's your cash position going to be at night? The detail of all your pricing and what is going on in your business. You need to have command of the nitty-gritty. This creates confidence in the management team, and tight control is essential when cash is tight, as it is in all startup businesses. Finally, let me remind you that investors invest in people that they know, like, and trust. And that's the whole objective of this course, is to put you into a position where they come to that conclusion about you. In the final video, I'm just going to give you a summary of the course and take you through what I've covered, just to wrap things up. So until then, thank you for your time, and I look forward to seeing you in the final video.